And joining us now to talk about the markets and what to expect and how to position, Dryden Pence is CIO at Pence Capital Management. Dryden, thanks so much for being here. Just firstly, we've seen a pretty resilient market that, albeit is being led by the mega cap tech stocks. Do you think that this has legs, though? Do you think that we are going to continue to see flow and continue to see this leadership that we've seen over the course of the past, I suppose, 2 or so weeks in these tech names, or does something have to give?
Well, I think that there probably is some legs here for the simple fact that people are realizing that the Fed is getting closer and closer to the pause. And when they stop and when they pause, whether it's in May or shortly thereafter, I think we begin to see tech stocks continue to be far more resilient and continue a situation where it'll be positive going forward. And the PCE number coming out tomorrow is important because it'll really drive the view of inflation and how close we are to seeing all of these interest rate hikes bite.
Right. And so what do you expect on the PCE trend?
Basically, core is going to move just a little, but headline is going to move a little bit more. We're just now seeing, we probably have only seen about 300 basis points of the 500 basis points move hit the market because lags here are 6 to 9 months, and it makes a big difference. We're beginning to see these things take some effect, even though the economy is really strong. And you're going to see that in PMI positivity. But the PCE is coming down a bit. Core is going to be sticky. We don't think it gets a lot lower real fast, but we think headline is going to begin to move down.
Headline is beginning to go. Do you see improvement on the services side of the inflation print?
On headline inflation for the next 2 or 3 months, we see some positive move because the comparative rates to high energy prices that we had a year ago, energy's come down a lot. So headline's going to move. Core is going to move much more slowly and be much stickier because the large services sector part of the economy is really continuing to go up. So we're going to see this convergence. You could see a moment out here in the next 2 or 3 months where you see actually core CPI and core PCE higher than headline, which is going to be a very interesting event as we move through this.
As the CIO at Pence Capital, how are you looking at your asset allocation strategy right now? We were speaking to a guest earlier talking about how global funds, European funds especially, US and European, are eyeing Asia.
I think for us, we're beginning to see some interest in outside the United States. We've been pretty concentrated in the U.S. because we see China opening. We see Asia having opportunities. The world is kind of moving in a multi-speed direction of recovery and also inflation rates. So I think that a little more global is necessary. But I think when we look at the United States, we're positioning ourselves where we've some mid-cap and we like large-cap tech. But also it's important to maintain a good view to value names and good view to things that have strong earnings and good dividends because we're going to continue to see some volatility this year until the Fed actually hits the pause button.
I've got to ask you, Dryden, do you think that this banking crisis is over? Because, everyone points to CRE, everyone points to the fact that there could be some pressure being felt there, but as everyone knows, it only takes one chink in the armour, one crack, because the Fed can't backstop everyone. And you've just seen today with NBC, one short seller report absolutely knocked the stock for 6. So is there any reason for investors to be, I suppose, hopeful?
I think that much of the U.S. banking concern or crisis has probably worked its way through. When you look at Silicon Valley Bank, and then globally you look at Credit Suisse, you look at some of the other banks were involved in this, a lot of them were just really poorly managed institutions, particularly in the case of Silicon Valley Bank. And so these, we think, are more isolated incidences as opposed to systemic risk like you had years ago. And we think the Fed has tools to backstop that. But I think what's really important is technology has made these banking crises a little bit different. It's not your grandfather's bank run anymore. People aren't standing up in line to pull deposits out of banks. 45% of the people are online banking. They can pull deposits really, really fast. And I think that technological innovation brings with it some risk when you see these run-on banks. And so when banks mix-match their liabilities and their maturities like SVB did, they could get themselves in big trouble. So I think there's going to be some new diligence on the part of the Fed, because they have to recognize that bank runs can happen in a day, not in a month. And I think that they're going to really have to be more on top of it from a regulatory standpoint.
How are you looking at the rotation trade into U.S. tech right now? How convincing is that?
Well, I think we like large cap tech, and what hurt technology companies so much in the last year was this transition and this increase in interest rates, right? So as interest rates went up, tech really got hit. Well, we're getting very close to the end of that cycle, and that will bring stabilization. And when that brings stabilization, technology companies are going to be able to be recognized for the cash and the value that they create and move forward on. So I think that it's very, very important to recognize we're probably 25 basis points to 50 basis points to a pause. And at that point, you're going to see the headwinds that were running against technology companies subside, and then they have an effort to kind of move forward what their more traditional path of growth has been.
On the defense side, you like Lockheed Martin as well as Raytheon, and also on healthcare, you like United Health.
Absolutely. I don't think that the war in the Ukraine is going to end anytime soon. It's going to probably go at least throughout the rest of this year. But even if it does, even if it ends tomorrow, NATO has learned a very valuable lesson. And you had 9 countries putting 2% of their GDP in before this happened. Now you have 19 pledging that. That's going to be about $800 billion worth of additional defense spending. The main beneficiaries of that are going to be companies like Raytheon and Lockheed Martin. They've got an order book that is 2.4 times their 2022 revenue. So they've got a couple of years worth of orders on the books already. And so even if the Ukrainian war ends, you've got to rebuild inventories and expand the NATO expenditures for defense. So we think those companies have the wind at their backs through order books for a long time. When you get to United Health, we also see that company, while it's been impacted a little bit during the last year, they have a very solid cash flow system, large government contracts. The American population is not getting younger, and our demand for healthcare goes up. So we look for companies that have big knowable themes and large trends behind them. And we think United Healthcare is going to be a benefit of just the natural aging of the U.S. population.
All right, Radin, we leave it at that. Thanks very much for joining us with your take on the markets. Really appreciate your time.
Absolutely. Thank you very much. Happy to be here.
You're very welcome.